Hello and welcome to Points Before Power. On today's episode, we are going to talk about a topic that really lights up the conversation at a party: credit scores.
Wow, Paul, you really do know how to entertain your guests, don't you?
You better believe it.
So, why are we going to be talking about credit scores?
I find that most people think of their credit scores as something to be locked away in, similar to, well, frankly, I don't know what it's similar to, Mike.
Perhaps it is a misunderstanding of how credit scores actually work and the importance that so many big decisions in life seemingly hinge upon that it is so guarded.
I think you're correct. Mike, those are the two facets we should examine today. One, how do credit scores actually work? And two, what is the significance of your credit score? Yet, I propose we start with determining what your credit score is currently.
When most people talk about their credit score, they're referring to their FICO score, which is a credit score created by the Fair Isaac Corporation. This is the score that lenders actually use. If you want this score, you will get it when applying for a line of credit, else you can pay FICO directly.
Mike, I believe Discover Card gives you free access to your actual FICO score, and so does American Express, but you'd have to double check that.
I think you are correct, and you don't even have to be a customer. However, enough smart people have back calculated their own formulas to get fairly accurate similar scores and use what is called a Vantage score. An example of this would be Chase. Most of this is still applicable as they are similar, but just so you're fully aware they're not exactly interchangeable. Looking at the FICO score chart provided by Experian, if your credit score is 761 or above, you have some wiggle room to lose a few points temporarily while remaining in the very good category. And I think most of our subscribers are 46 percenters.
So now that we know what our starting score is and that we have some room to move, let's see what makes it tick. According to FICO, there are 5 major components to the score. First, payment history. 35% of your score is made up of the fact if you pay your bills on time. Second, the amounts owed. 30% of your score is based on this. So these are things such as credit utilization ratio on revolving accounts. So essentially, how much of your credit on your cards are you utilizing? For example, if you have 2 cards, both with $5,000 limits, and you put $1,000 on each card per month, you'd have a 20% utilization. Less than 30% is a good place to live. Third, length of credit history. 15% of your score is made up of this factor. The major focus here is how long your credit accounts have been established. It includes the age of your oldest account, the age of your newest account, and an average age of all of your accounts. Quick tip, do your best to avoid canceling your oldest card. Number 4 factor, your credit mix. 10% is based upon this. FICO scores will consider your mix of credit cards, retail accounts, installment loans, finance company accounts, mortgage loans. Don't worry, it's not necessary to have one of each. Finally, the 5th factor is new credit, and 10% is based upon this. Opening several credit accounts in a short amount of time represents an individual who's a greater risk, especially for people who don't have a long credit history.
That's a nice rundown. It seemed to me that some of those factors contradict each other. For example, if you were to open a new card and increase your available credit, that would reduce your utilization and increase your score. However, it would reduce your length of credit history and to your new credit, both factors that would reduce your score.
You're absolutely correct. And in my experience, I've taken a small temporary hit only to have my score overall increase as the new credit and length of credit have increased. In short, I've been doing this responsibly and methodically for over 3 years now. And in doing so, my credit score is higher now than when I began. And I've had some really great vacations because of it.
In general, having good credit can make achieving your financial and personal goals easier. It could be the difference between qualifying or being denied for an important loan, such as a home mortgage or car loan, and it can directly impact how much you'll have to pay in interest or fees if you're approved. For example, the difference between taking out a 30-year fixed-rate $250,000 mortgage with a 670 FICO score and a 720 FICO score could be a $72 difference a month in a payment. That's extra money you could be putting towards your savings or other financial goals. Over the lifetime of the loan, having a good score could save you $26,000 in interest payments. Additionally, credit scores can impact non-lending decisions, such as whether a landlord will agree to rent you an apartment. Your credit reports but not consumer credit scores, can also impact you in other ways. Some employers may review your credit reports before making the hiring or promotion decision. And in most states, insurance companies may use credit-based insurance scores to help determine your premiums for auto, home, and life insurance. And I would not argue with any of that. However, I don't think a score of 770, 760, or even as low as 730 will give you a better mortgage rate relative to each other. The goal here is to stay in the good or excellent category.
I hope everyone found that as useful as I did when researching and relearning much of that topic. Take care.
Thanks for tuning in today, everyone. And again, if you have comments that you want to add or if you have questions, leave them in the comments below. And feel free to like this video and subscribe so you never miss any of the latest content. Thanks.